As one of the vice presidents here, I manage a lot of strategic relationships like this. We work with financial advisors and wealth coaches throughout the country, and they help their clients get involved in this strategy when it's a solution for them. And the main premise of it is to create freedom number wealth, where you have enough passive income coming in to cover your expenses in retirement and not have to worry about running out of money. And the problem has been ongoing for 30 years. A lot of you have taken the first step by being here and investing alternatively and learning about alternatives. But for the vast majority of Americans, they're not. So I appreciate the opportunity to be at this event and to be introduced to some new people who are just now learning about the power they can use in their 401k. One you've probably heard a lot about is Social Security. And the Business Insider study shows that by 2035, we will receive 21% less from Social Security than is being received today. So imagine losing 21% of your main source of income. And right now, 50% of retirees who are a couple rely on it as their main source, and 71% of individuals do. So that's something that you're going to have to make up for one way, and one way is a pension. Well, unfortunately, the risk of companies, they're pushing it off onto the individuals, and you can see that pensions have gone from 30% to now below 3%, but what's increased is your defined contribution plan, which is your 401k, what you contribute to, and you have control and responsibility for creating your own retirement. We're all here, so I won't focus too much on it, but the 401k is a terrible vehicle right now. When it's traditional, you have a very small selection of options. The returns are abysmal, 1% to 4%. The best part about it is the match you get, which you lose upon retiring, and the fees are detrimental to you. SEC study shows that a 0.75% difference in fees in the portfolio will cost you $30,000 over 20 years. And the average loss is over $155,000 in the retirement account. So it makes a huge difference when you self-direct and invest in alternatives that don't charge fees versus staying with the same traditional options. This is a great event because we're learning about this, but even today, only 4% of IRAs are self-directed, and that's over $7.3 trillion. And coming into retirement is $4.2 trillion more in 401ks. And studies have shown that 75% of retirees will not reach that financial freedom number where their passive income meets or exceeds their expenses with their current strategy. So unfortunately, those results are being felt today. 3 times as many people are declaring bankruptcy in retirement than they were in 1991, and it all has to do with that 3-decade shift. So what we've done at SDIRA Wealth is simplify what's given over 90% of millionaires their wealth, which is real estate investing, owning actual tangible assets. You know, one of the few election cycles ago, Mitt Romney, it came out that he had tens of millions of dollars in a Roth retirement account. And no one could believe how that happened. There were articles and studies done about it. It's pretty simple. He didn't invest like 96% of Americans did. He self-directed and invested in alternatives he knew and understood and made strategic moves to generate returns never seen by your brick and mortar financial institution. So it's great we're here. It's great we're having this event. And it's great you're going to learn about a lot of different strategies that might be the right one for you. So what we do is real estate, but it's done in a way you've probably never seen before, where we're actually the only company in the country that secures non-recourse financing, and that supercharges your return with a rental property more than you ever would get just buying it cash. I'm going to show you how we do that. We also develop and build new construction throughout the country. That's our roots. So we have new construction properties that are fully managed, fully occupied with tenants, where you don't have to deal with all the less fun parts of a rental property and leasing it, finding tenants, turning it over to new tenants. We have an on-site team and a separate in-house team overseeing it to keep it very easy for you. So we do all the front-end due diligence. This is kind of the motor under the hood of our investment vehicle. 18 to 24 months of looking at building permits, vacancy rates, what job growth is going on. And we love college markets. We love emerging markets with heavy job growth. And we do love Texas. No state income tax, very pro-business. A lot of California businesses are moving here. So we've done tens of millions of dollars in investments in Texas, and we're building stuff here right now. We secure the non-recourse financing, so when you buy a property from us, you can buy 3 for the price of 1, set up the management, and ultimately we're your partner. We're not looking to do one-off, two-off deals with our clients. We're looking to provide a solution that they can benefit from, where they want to be advocates for us and they want to tell their friends and family and add on more themselves over time. So tonight we're going to focus on the financing and how we supercharge your retirement account with non-recourse financing. So the first question we get is, what is non-recourse financing? Well, the simplest way to think about it is it's a mortgage that's tied to the property. If you think about the mortgage on your primary residence, where you went to your Bank of America, your Wells Fargo, you gave them your income, your W-2s, everything short of a blood sample, where you're personally liable for that loan and the bank's looking at you first and your creditworthiness to pay back that loan. Now, there's a problem with that and the IRA is they're not compatible. A personal loan tied to your credit line is not something you can give to a property that's being bought by your IRA. In the IRS's eyes, that's considered providing a service to the retirement plan, so that's prohibited. You're not allowed to do that. So the only type of financing you can use to leverage your retirement dollars is non-recourse. The problem has been most banks don't offer it. It's considered risky. The bank has no leverage over you on this deal. The only collateral is the property. So it's very hard to get. Lenders are looking at the price of the property, the condition, the market it's in, the team that's managing it, the income it creates, and they're making a decision on whether to lend or not based strictly on the merits of the property. So for a lot of new clients who come to us, they have a lot of peace of mind knowing a lender's vetted this deal and is putting in 2/3 of the purchase price for them to buy it. Now, the second question we get is, why would I do this? Why would I take out another mortgage? Why, if I have enough cash to buy a property all on my own cash and not have to worry about a mortgage payment? That's a great question. The reason we use leverage strategically is for 3 separate reasons. You're going to make a higher cash return right off the bat. You're going to appreciate at a higher rate. And you're going to put yourself in a position where you truly hedge your risk. So let's start with the income. This being an income-based investment is the most important piece of the equation. If you're looking at the left there, that is a $150,000 house. And if you're looking at the screen on the right, it's the same house times 3, where you're taking advantage of this financing, putting a $50,000 down payment on each house, and getting the non-recourse loan that's pre-approved, so you're able to buy 3 of them for the same amount invested. If you're looking on the left, you've got $150,000 invested, $1,300 in rental income, $200 in taxes, $40 insurance, management $100, and $40 in maintenance. So you're netting $920 a month or $11,040 a year. Now that's a 7.4% return. Much better than what most 401ks are offering, but not great by any standards. If you're looking at the right, you're investing the same amount, but you're buying 3 of these homes. So you're getting 3 times the rental income. You do have the mortgage payment on all 3, that's $1,650 a month, triple all the expenses, and at the end of the month, you're netting an extra $190 a month, or over $2,000 a year in extra net income for the same amount invested. Now, our investment offers you 3 streams of revenue right off the bat, cash flow being 1, equity being number 2. Same principle with the mortgage on your house. When you make a payment, it's not all going to interest. A portion's going to principal because it's amortized. Same thing's happening here, but you're not paying the mortgage. The tenant who's paying to have a roof over their head is. So you're making an additional $4,650 in equity, reducing the principal balance on that mortgage. So your total return without appreciation is 12% versus 7.4% on the same properties, same everything, just taking advantage of the financing we have pre-approved. 10 years down the road, you're looking at over, it looks like it didn't copyright, but it's over $60,000 more in income by using this leverage. And the appreciation rate, that's what we kind of consider the cherry on the top. Most clients hold on to these forever and keep the income. Every situation's different. I just sold one of my properties from 2015 because the market did what it was supposed to and increased. But it's up to you when you want to sell it. What's great about using leverage for appreciation is you own 3 times as much real estate. So if you think about the one house for $150K, if it goes up by a measly 2%, that's a $3,000 gain, 2% growth. Now, if you own 3 of those same houses and they go up by 2%, you have 3 times that $3,000 for a total of $9,000 growth. Think about where we are right now in Dallas in 2011, 2012. Imagine if you bought 1 house in 2012 and sold it today, or 3 houses in 2012. How much more money would you have made over these last 6 years with the growth we've seen in this market? It's also one of the tools that the rich use, is using these banks to their advantage to make a higher return. Another reason is to hedge your risk. You know, if you're buying a $150,000 house, that's it. That's what you own. It's 1 house. You're relying on 1 renter for your income. If you're spreading it out into 3 separate properties, you're hedging that risk. You're not relying on 1 renter. If a property is vacant for 1 month and the other 2 are cash flowing, you're still making money. And it's great to spread it out into different markets too. A lot of our clients, when they start, they buy a property in Connecticut, Florida, and Texas as a starter portfolio, where they're not only diversifying into real estate, but they're diversifying geographically. And if you think about that, it's a headache, right? You're going into 3 different markets, 3 different managers, you're dealing with all these monthly expenses. That's how it normally is. But with us, we have that in-house team I mentioned. They're with you throughout the process. As you add on more properties, you get a dedicated contact there. And what they do is simplify this for you. They stay on top of the managers, so if you ever have a question on one of the monthly statements you get, you can give them a call. You ever have a question on anything, they oversee all of your properties. So it's very scalable. Whether you have 1 property in 1 market or 10 in 10 markets, it's going to be the same process, and our clients love that about how easy and simple we make it, and how easy it is for them to keep adding on and keep generating more and more income. Those are some of the benefits. We have this poster out here on our booth in the back left corner if anyone would like to take a copy of it and learn a little bit more. Clients we have love what we do. Proud to say that over 80% of our clients have bought multiple times. We've got a lot of reviews and case studies on our website that you can check out. Doesn't look like I might have time for a few questions, but I want to leave you with one thought on how to determine if this solution is something that would be a good fit for you. Now, this is great for somebody who wants that passive income, the mailbox money, but doesn't want to deal with finding and rehabbing properties, identifying which pockets in the city make the most sense to invest in based on schools and building permits and vacancy rates. Somebody who doesn't want to worry about hiring contractors or interviewing the right property managers. You know, it's a great solution for that person who wants to be passive, but if you're a hands-on real estate investor and you enjoy doing all of this yourself, that's great. It's not the right fit, but if you can envision yourself in retirement, just having a portfolio, creating that mailbox money, that passive monthly income that you don't have to worry about, this is definitely something you might want to consider. We're in the back left booth. We also have a raffle for $300 cash going, so if you haven't signed up. And we've got a link to a special page on our website where we're giving all of our ebooks and educational information for free to anyone who signs up on our website. So you can learn a little bit more, get your questions answered, and see if it's something that's the right fit for you and getting you where you want to go.